Francesco, thank you so much for joining us here at SuperReturn Europe. Lovely to have you in our studio, and you were in a panel today that was specifically looking at and discussing LP perspectives and how investor demand for private debt has evolved over the past sort of year in Europe. Tell me what you're seeing in those terms and what the landscape looks like in Europe for private debt.
Thanks very much for having me, first of all. Yeah, I was in the panel, and I think that over the last year or so, I think the LPs are becoming more and more sophisticated in that, I guess they don't want to do as much direct lending as they used to, or at least we don't. We have a pretty sizable direct lending portfolio, and we as LPs are slowly moving to other strategies to try to get a maybe higher yield or a differentiating edge. For instance, one of the things also I mentioned in the panel is that we're moving towards special situations strategies as well as asset-based lending, which we have started to look at since, I would say, the end of 2023, beginning of 2024, so it's about a year. Of course, the portfolio is much smaller because especially a lot of these managers are potentially very small, or not very small, but much smaller than what we used to, so the ticket size that we can do are, as a consequence, more. And then also, more recently, we have looked into this private credit secondaries, which is another aspect.
Tell me about that. Tell me about the secondary space, because it is an attractive market from what you've been talking about on stage, and what opportunities does that offer in this sort of environment?
Right. Yeah. I think that the main thing is that the private credit secondaries market is growing, and it's something that we've tried to surf this wave, if you allow me to say. So that more or less there are different estimates, but the private credit market is about $1.7 trillion in size. And it's projected to continue to grow at maybe 15% per annum, so that's quite substantial. And the private credit secondaries market is also growing, and I think this is it's structurally, as the primary market increases, the secondary market will also increase, similar to what happened with the private equity space. But also, as the portfolios become more and more mature, there is more and more these portfolios become more and more attractive for secondaries. For instance, because you have two main types of transactions in the private credit secondary space. You have GP-led or LP-led transactions. As the portfolios mature, you're more likely to be seeing this. And then the third, I think, a very important factor is that there are a lot of specialized players that are developing. You have both on the investing side, so investors that are only dedicated to that, and not only us, but there's, of course, much bigger players, and also you have dedicated advisors. And the market is, it's increasing. So we think that this is a particularly attractive point, also because it's very attractive for the investors, because you basically decrease the J curve, which is the time lag that goes between when the capital is committed and when it's called. And in secondaries, because you're investing in funds that are already invested, you get called much sooner, and you start getting distributions early. This is why we think that this is a good market to be in.
So, it is quite different from traditional private credit from what you're describing there.
It is quite different, yes, but in the end, the underlyings are pretty much the same. So it's the only difference is that you're buying, in a way, a more mature portfolio. So you actually have more visibility on what's there, which is decreasing also the risk in that respect.
And so do you think it is appealing because of that, as you've just said, that it is seen as lower risk and perhaps a safer haven in this current environment?
I don't know how much, that's of course one of the appealing side, but I think the other appealing side is that if you shorten the duration, then also the returns also for the investors go up. And we think that
when everyone's looking for liquidity at the moment,
exactly.
That's kind of
so
appealing.
This is appealing, and we are there to offer it. And of course, the market is quite competitive. When we thought about launching this about last year, it was not as competitive. Now this year it's become more and more competitive. But we are there. We're trying to also through our network, because it made sense to us because we have a pretty large primary portfolio, which means that we have a pretty large network of GPs. And this allows us to originate on a bilateral basis also.
But you're having to work hard because it's competitive, as
yeah,
you said.
Yeah.
That's good.
And the thing is that, we're not used to this, or at least I wasn't, because we bring a deal to IC and then we have to actually submit a bid. It might not be one, so we might be working for nothing. But this is part of the game, and I'm happy to see this new market. I'm excited about it.
Nice returns. And how about the fact, how does that space look in Europe specifically? Because obviously this is, the Europe-focused Super Return event, and there's been a lot of talk all year about a swivel from, US to Europe as a place to invest. What are you seeing in terms of the opportunity in this geography?
I think that in Europe in general, I mean, the market is maturing, so it's clearly less mature than the US, but that's a given. But I mean, it's coming also in Europe, and I don't mean only of course, secondaries. And we have our fund is also targeting Europe, and this is one of the differentiating points as opposed to other big players or other players that are there, because we think that in Europe there are still a lot of GPs, and they might be potentially interested in doing continuation vehicles or these sort of things. And this is true also for the other strategies. I mean, we try to keep our portfolio balanced between Europe and US. So I think that, yeah, Europe is a pretty attractive place, and also given the turmoil or volatility that's in the US market, it's nicer to, there's been this shift, also was mentioned in the panel, this shift more towards Europe. So
good news for you guys. And just finally, what are you most excited about in the next sort of year to 18 months in this space, and what are you looking forward to as we go into 2026?
I mean, I guess hoping that there won't be any geopolitical catastrophe, which is unpredictable, and we know where it can come from and who it can come from. But hoping that remains the case. I think that as the market matures, we'll hopefully have more and more opportunities in the secondaries space. And also this increased volatility that's created is potentially very good for private credit, because as the public markets are potentially shut, the players that would normally rely on the public market, they would go into the private debt, and that will increase the deal flow as well, which we as LPs are happy, and potentially the terms will become more and more lender friendly.
Francesco, thank you so much for joining me. It's great.
Thank you.
It's great to talk to you.
Thank you.